On Wednesday, the Fed, as you know, left rates unchanged, as widely expected. It continued to pencil in 2 rate cuts by the end of the year, while also hinting at concerns about stagflation. For more, let's bring in Roger Ferguson, former Fed vice chair, as well as a CNBC contributor. And when we're on hold and we have you on, Roger, we've always got a lot to talk about, but sometimes it seems like we're talking about the same thing over and over again, and you kind of, you tell us just relax and probably not the right time to cut. I'll tell you what hit me today, and that was this headline. Fed waits for the dust to settle on tariffs before a rate shift. Now, I think what that is implying is that they need to know what the inflationary aspects of tariffs are before they cut. What I'm saying is, if we're waiting for the dust to settle on tariffs, it could also be a growth concern about tariffs. I mean, that's what I'd be waiting to see the dust settle on. How much uncertainty have the tariffs caused? How much with consumers and CEOs? So for me, I'd be more worried about that and missing the opportunity to cut. Is there any way the next move is a hike? No, it's not going to be a hike. Is it? In any world, is it going to be a hike? So we're really just deciding on when to cut. And if you're waiting for the dust to settle, I'd be cutting before watching the labor market or the economy weaken. I convinced you?
Well, Joe, first, no, I'm not convinced. Good morning. I find your analysis interesting, but as you say, I'm not convinced. And look, the Fed's not convinced. So while you say that 10 of them penciled in 2 rate cuts this year, what was very interesting to me was the number that penciled in no rate cuts this year. 7, and then 2 said maybe 1. So I think this is a Fed that's evenly divided, and I'm not at all sure that even when the dust settles, they're going to feel very comfortable about taking one move or the other. And you pointed out exactly why. They are looking at something that feels like a mild version of stagflation. And with inflation not coming down quickly enough, I think their hand is going to be held for quite a while before they even seriously start contemplating rate cuts. So I appreciate your analysis. I don't think it's the one that's shared mostly by the policymakers.
Don't you think that that's dependent on the assumption that these upcoming data are going to show a tariff effect on inflation? Everybody's telling me, this is, Leisman, this is the time. Okay, we're finally going to, okay, this is going to be the one where the inflation numbers are going to be hot. How do we know that this isn't the one where the labor market is, with claims and other things, it seems more likely that we could see weakness rather than inflation?
Oh, look, the odds of so-called stagflation, I think, have gone up. I don't think that the challenge for the Fed is while we might see slowing growth, slight rise in unemployment. I reported a little while ago a CEO confidence index that really swung to negative territory. They're also penciling in an increase in inflation. So for a central bank that's got a dual mandate, it's sort of stand pat time. And I believe that if they want to maintain the inflation fighting credibility, before they focus on the weakening economy, they need to focus on and be clear that they're not going to let inflation get out of hand. And so given the history they've had over the last several years, I really don't think they're going to pivot to rapidly cutting rates unless they're 100% certain or much more confident that inflation is not going to be their major problem. So I still think, on hold for much of this year.
It would just be if you got burned on being too easy for too long. It would be bad if that, if your reaction to that was, okay, I was too easy, no matter what, we're not going to be easy again. And when in one case you shouldn't have been, and in the other case it was a time that actually called for that.
Look, so I agree with your general thoughts that 2 wrongs don't make a right, so to speak. I think where you and I are disagreeing is the combination of inflation rising, and they're now predicting core inflation with a 3 handle this year, and I think 2.8 next year, something like that, 2.7. That's not moving in the right direction. And I think the most important thing for a central bank is to maintain inflation credibility. So I think where you and I are disagreeing is in the face of stagflation, with inflation high and the economy slowing, which thing do you look at first? And I guess my view is look at inflation first, and maybe I'm sort of surmising that your view is, well, look at weakening growth first. But, either way, it's a bit of a dilemma for them, and therefore, on hold, wait and see is going to be the mantra for the next several times, I think.
What do you think Chris Waller is going to say today when we talk to him? I think he's going to, we're going to have a bromance.
Look, Chris Waller is really very capable, as you know. I think what he's probably going to say is he expects any inflationary impact of tariffs to be, short-lived. I hate to use the word, but transitory. That's what he said the last time around. He is very well respected, among economists, among policymakers. But I also think that is not necessarily the consensus view, that most policymakers are not 100% convinced that any inflationary impulse from tariffs will be temporary. Right. The other thing, by the way, while we're focused on tariffs, there's also some concern about the quality of the labor market, and with action against immigration, what is that going to do for, in some industries, labor supply? And the final thing the Fed's talked about quite a bit that I'm sure Chris is focused on is so-called inflation expectations, not just long-term but short-term. So there's a lot that's weighing on them. I think that's putting them in this wait-and-see position. All
right. I tell you, when President Trump talks about it, and I don't like the pejoratives and the disparaging necessarily of Jay Powell, but when you look at the rest of the world and what borrowing costs are, and when he puts it in terms of if we were a point lower, and I could lock in long-term rates all these things are rolling over, and if I could lock them in a point lower, this is the amount of money we're talking about. It's like. Wow, it would be good. But then again, you don't want to let the inflation out of the bottle when it's contained. You don't want to do that. But in a perfect world, you'd always like, as a issuer of debt, you'd always like, lower interest rates. So, I get what he's saying.
Oh, there's right? I get what he's saying, too. I agree with you. I don't think the pejorative nature of the comments is helpful or appropriate. But I also get what he's saying, as you are, that we are a borrowing nation, therefore lower rates would be approved or helpful. But I think the president also knows that he was elected in part because of inflation concerns and inflation experience that people have had. Right. As a wise leader, he would certainly say he does not want to see, as you are saying, the inflation the inflation genie out of the bottle again. So. I think the president, if he were really focused on all sides of what drives this economy, might be a little bit more neutral as well.